My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. People want to make friends, just trying to make a little money. My job is not just to entertain, but to educate and teach you. So call me, 1-800-743-CNBC, or tweet me at Jim Cramer. On a day when we shrugged off the Fed's taper announcement, Dow actually gaining 105 points, S&P advancing 0.65%, and the Nasdaq jumping 1.04%. Wow. You need to understand that this is a market where the tail can indeed wag the dog, where what's happening to a stock can be more important than what's happening at the underlying company itself. Now, we've always had some stocks that traded more on individual excitement than institutional fielding. I created the acronym FANG in order to capture that. FANG because Facebook, Amazon, Apple, Netflix, and Google were beloved by home gamers first, not by institutions. The home gamers who kept buying them and making fortunes, even as the big money people on Wall Street remained skeptical. At one point, all these stocks were derided as being too giddy. Giddy being a code word that means something rallying because of dumb money. Wall Street speak for you. Yeah, regular investors, you. I rebel at these condescending judgments. Big reason, by the way, why we created the investment club here. And I often share your enthusiasm for stocks most pros denigrate. But these wise men are very often betting against your instincts. In particular, you had a whole cottage industry of experts who crow about how Amazon and Netflix would never, ever turn a profit, no matter how much you like their services and products, no matter how much you paid. Many of these so-called professional money managers were too skeptical, too pessimistic. It's in their nature. They thought these companies were run by dreamers with their heads in the clouds, when in reality, the CEOs of Amazon and Netflix were ruthless businessmen who also happen to be visionaries. Today, both companies are incredibly profitable, but the skeptics have never been held to account. That's what we do here. Well, then Tesla came along. That's one of the greatest stock stories ever told. This is a company it's now worth $1.2 trillion. Even though it'll be lucky to produce 1 million cars this year when Ford, GM, and Toyota collectively make tens of millions of cars, yet when you lump them together, they're not even worth a fraction of Tesla. Maybe it's not so much a car company. Every step of the way, you heard that Tesla's valuation was totally divorced from reality, and every step of the way it kept going higher. You can't justify that market capitalization on the basis of the numbers. You can only justify it on the basis of vision. If electric vehicles are indeed the future of the auto industry and Tesla's the future of electric vehicles, then $1.2 trillion might not be a stretch. But professional money managers generally disdain that kind of analysis. I find it as free-thinking and rigorous. Which brings me to the events of the last 24 hours, where canny individual investors have reclaimed the valuations of all sorts of companies with the aid of some shark-like hedge funds who smell the blood of short sellers in the water. Yesterday, we saw a monster move in Avis that was really kind of, this is watershed stuff. You can't just say, oh, that was yesterday. These things have to really be dealt with head on. I'm not leaving it after one day. See, this was seminal in the way it went up. And today, at least at the opening, we got an amazing run in Bed, Bath, and Beyond, okay? Now, a huge part of these gains is similar to what we saw with GameStop and AMC. If you can take a look at the Bed Bath, you can see what I'm telling you about. Saw these at AMC, and we saw that in GameStop in January. If you notice, this is the kind of parabolic move, okay, where I'm saying these are watersheds. You don't get these in normal markets. That's why we're addressing them. See, there were tons of short sellers betting against this and betting against Avis, and they went against the traders in favor of you. And that forced the short sellers to buy back stock in order to close out their ill-advised positions. Large hedge funds realized that you were going to take this stock up, and so then they decided to crush the hedge funds. And it worked. Two different kinds of hedge funds, the shorting kind and the long kind. Now, in the case of Avis, the rental car company reported jaw-dropping quarter where they earned nearly twice what Wall Street was looking for. In the case of Bed Bath, they announced a joint venture between their Buy Buy Baby unit and Kroger, something I talked about with CEO Mark Tritton on Squawk on the Street this morning. Bed Bath also accelerated its buyback dramatically. I bring up these two because they are fantastic illustrations of how the mechanics of money management can impact individual stocks and about the change in this environment. See, hedge fund managers often have a huge disadvantage during a bull market like this one. Many of them have no choice but to run what's known as a balanced book. Balanced book. Meaning their long positions and their short positions, what they own and what they sell against, should be even. Basically, the clients are using them to hedge what otherwise would be straight ownership of good companies. In other words, there are tons of hedge funds that have to short stocks. It's in their charter, so to speak. Even in a fabulous bull market, they need to find something to bet against. So they're always looking for targets and shorting the uneven Bed Bath & Beyond against, say, a Macy's or a Costco, which had fantastic numbers tonight. They had these guys at Bed Bath, they did have horrendous management before Mark Tritton came in. And by the way, last quarter was a disappointment for Tritton because they had the wrong kind of promotions. And maybe that's why more than 28% of the shares that trade were sold short as of this morning. But the short sellers made one mistake. They forgot what happened earlier this year when a brand new cohort of investors started shooting against the short sellers anytime they got too crowded, anytime there were too many of them. And that's why Bed Bath & Beyond finished today up more than 15%, but at one point was up more than 50%. Memo to the shorts. If you think you are shooting fish in a barrel when you go after these companies, well, you may not be the guy with the gun. Buy Bed Bath & Beyond on this pullback. It should be bought. The Kroger opportunity is too big to ignore, and I bet the shorts aren't finished covering. Okay, how about Avis? Now, this was even dumber. Lots of money managers wanted a piece of Hertz, its competitor, which was cheaper than Avis and had a better story. But the ones who run what's known again as a balanced book needed something to protect them from the downside. So when they went long Hertz, they shorted Avis. They didn't understand that they get wrecked if we got any good news. So when Avis reported a blowout quarter thanks to the auto shortage, the stock exploded, and the shorts got to experience what it feels like to lose more than 100% of your money. Now, what matters here is what didn't matter, and that's the traditional valuation metrics that so many money managers come on air or in the papers or tell their investors is what really matters. Should Avis have added $10 billion in enterprise value due to a single quarter? No, it shouldn't have. It is superficial. Should Bed Bath run like this when it recently reported some not-so-hot numbers? I can spin out a story about how Bye-Bye Baby division could be worth the current price of the entire company, something I tried this very morning, but Triton wouldn't take the bait. Otherwise, no, probably wasn't. But at the end of the day, these stocks are like GameStop or AMC, in that at their highs of the day, they did divorce themselves from the fundamentals. It happened. Now, maybe the better comparisons are Netflix and Amazon, which made you fortunes in the face of heavy shorting, even though their valuations were totally unjustifiable until many, many years later. Netflix and Amazon were about superior producers, whereas GameStop and AMC are simply about the mechanics of the market. I don't think anyone honestly believed these stocks deserved to trade as high as they did early last year. But the buyers took their cue from Clint Eastwood in Unforgiven. They realized that deserves got nothing to do with it. There were simply too many short sellers who had to capitulate, and their surrender sent the stocks into the stratosphere. That's what we saw in Avis yesterday and in Bed Bath this morning. Again, this is the revolution, okay? These are people who typically have not owned stocks. They come in, they buy them up, and cause the short sellers to capitulate, which is probably right here, and then the short sellers probably come back at the end of the day. But they're about to get hit again. Now, there will always be shorts that go awry. Look at this one. There were a ton of short sellers who got steamrolled at Estee Lauder just yesterday. Okay, this is what happened. First, the stock got crushed, okay? People thought the numbers could be bad. And then they listened to the conference call. They realized they were on the wrong side of the trade. It was a good quarter. See, the hedge funds bet against it because they figured the Chinese business would be hammered, not unlike Nike. That turned out to be a myth. I see the fingerprints of hedge funds all over this mistaken thesis. Also a sizable bet against a company that we all know now is worth every penny, Moderna, every step of the way. That one hurt to watch because the bull thesis was so irresistible. They got a vaccine, we got a pandemic. Well, why would you bet against that? Might as well punch yourself in the face. But the bottom line, we now live in a world where individual investors like you have realized that they can destroy the short sellers whenever the short sellers get too overconfident. They know they can pressure the shorts and force them to capitulate, as I just showed you, whenever they crowd into a stock. And a bunch of short sellers surrendering en masse will indeed cause any stock to do what this did. And that's what created stocks like situations like Avis or Bed Bath, and it created GameStop, and it created AMC, and I bet we'll see many more of those until hedge funds learn their lesson. Stay away from crowded shorts.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. Hashtag Mad Tweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.